And welcome back. This is the last of our video briefings for this particular unit and the last of the stock market ones as well. So today we're talking about the stock market crash that happened in the 30s in United States history between the World War I and World War II. How in the world did this happen? So let's dive right in and talk about the stock market crash, how it happened, what was going on. And by the end of this particular time of together in this video, you will be able to describe why the stock market crash occurred in the United States back in the 1930s. And you'll complete an assignment to that effect. Mainly, here's the reason. I'll give it to you right out the bat. Buying stock on margin or on credit or over optimistic speculation. Those two reasons. Over optimistic speculation and buying stock on margin. So there's a video here, the stock market crash 1929. I'm going to put a link in the video in the notes for you for this, because the video is really going to break it down really well for you, and I don't want you to miss it. It's a great video on this topic. But ultimately what it's going to tell you is that in the 1930s, the stock market, especially coming out of the 1920s, which was called the Roaring 20s, the stock market was absolutely blazing. People were making money hand over fist. Companies were growing and growing and growing, and America was expanding, and people just were very over optimistic. There's speculation, which means like they're estimating, they're guessing as to where the stock market would be in the future, was over optimistic. They were way too high on it, and they got to the point where they didn't think the stock market would ever shrink. They were way too optimistic. And so everybody wanted to make money in the stock market. And so even people who didn't have money wanted to buy stock. But how are you going to buy stock if you don't have money? How do you get money? Well, you do it the same way businesses do. You take out a loan, and that's what they did. So people would go and take out loans from the bank, and then they would use the money the bank gave them to buy stocks in the stock market. Now, it's a bad practice for banks to be loaning out money for people to buy stocks with them. That's a bad investment from the bank, because that's not sure income. That's not sure income at all. But the bank thought it was sure, because they were over optimistic about the stock market. Inevitably, like a big balloon that gets too much air, what eventually happened is banks loaded people up with loans, giving people money, and people took that money and put it into the stock market. And eventually the stock market exploded. It blew, it crashed, and everybody lost money. And that is how the stock market crash happened, because at the end of the day, when the stock market crash happened, that's how we get into the issues that we did, which was simply this: eventually everything what comes up must go down. And unfortunately, those people who invested money in the stock market lost their money. But it wasn't their money, it was money they loaned out from the bank. So they couldn't pay the money back to the bank. The bank had no money because the bank loaned it all out. So the bank couldn't give people the money that they had invested in the bank, which means banks started to close all over the nation. They had to shut down, they had to close their doors, and suddenly we are thrust into what's called the Great Depression. That and a number of other reasons: bank failures, the stock market crash, other bad business practices led to a financial crunch, the likes of which America has hardly seen since then. There's more that goes on in this, and that video is going to break down more of how the stock market crashed, the panic, the runs on the bank all occurred. But what is a stock? As we said, as a quick review over all of this, maybe, there it is: a share of a company sold to investors in exchange for capital buying a small part of that company. What is a measurement of how well a stock is doing? The Dow and the S&P. True or false? Virtually every social class in America was putting money in the stock market in the 20s. That's true. Oh, there it is. I put it over there. Over the course of 4 days, the stock market lost what percentage of its value? 25%. That's a lot. And lastly, why do you think unemployment rose so drastically after the stock market crash? Banks were calling loans on those who had bought on the margins, or basically they had bought stocks on credit, on money they loaned out from the bank. So the bank started asking those people who invested that money to pay it back. The problem is they didn't have that money because that money was gone. So the loss of the money in the market would have caused massive reduction in the GDP of the nation and therefore a rise of unemployment, or essentially businesses started shuttering, and GDP, called gross domestic product, which we'll talk about later, is basically how the expansion of a country's economy, the more stuff a company or an economy produces. And the fact that there was a massive reduction in the ability of America to do business and expand businesses lowered America's GDP as a whole, its ability to produce more stuff. And essentially, more people being laid off, companies were slowing down, less was being made, GDP was shrinking, wealth all around was going down, unemployment was going up because businesses couldn't afford to hire people to do work because they couldn't afford they didn't have the money to do it because nobody was buying from them because nobody had money to buy because they had lost it all in the stock market. It was a snowball reaction that created massive panic. Again, I'm going to put that video up there for you to see because it breaks down how this whole thing fell and how the stock market crashed and what ended up happening and its effects and the long-term effects of it. And also, well, it won't get into how World War II helped to jumpstart the economy again, but it kind of did, and it pulled America out of depression. But for the time America was in it, it was a hard time to live. A lot of scrimping and saving, a lot of poverty. So that is the whole of everything we had to talk about: investments and bonds and stocks and taxes. We return. In our next unit, we'll be talking a little bit more about GDP and the Federal Reserve and the role of money in American banking system, and so on and so forth. So take care. It was good to have you on this video session, and we will see you in the next one. Take care.